ladies and gentlemen, we are ready for our next panel. We are looking at ESG and sustainability. And I mean, this is a topic that has been very much in the limelight, not just in the financial sector, but really in every industrial sector around the world. And you know, there are many, many different opinions across this that have been written about, that have been spoken about recently. Some feel that we have not done enough, and others wonder if it is even appropriate to be addressing these issues within the financial sector. Perhaps they are best left somewhere else. We are going to get into it on stage with our next panel, which is going to be ably chaired by Mr. Paul Yang, the CEO Asia Pacific for BNP Paribas. Paul, please come on up here and get ready to command this panel. He is going to be joined today by Valerie Baudson, who is the CEO at Amundi. Thank you very much for joining us. We also have Mark Carney, who is the chair of Brookfield Asset Management and the head of transition finance. He is also the United Nations Special Envoy on climate action and finance. And rounding out the panel, we have hot off his appearance at Hong Kong FinTech Week, Bill Winters, the Group Chief Executive of Standard Chartered. Paul, the stage is yours. Thank you.
Well, thank you, Andrew. Hello, everybody. So maybe, given that I understand that we are running a little bit late, I forgot. I should start immediately. So I think we've seen these days that ESG has been, as Andrew said, very serious. Nonetheless, I think there has been some sentiment recently about, you know, that actually the funds are slowing down. So is there any confusion about what is transition, what is ESG, what is the sustainability? So maybe I start with Mark. Do you have any, can you tell us about what you feel about this thing? Are we seeing some slowing down in ESG?
Thank you, Paul. Eddie, thank you. This is absolutely extraordinary. Even better than last year. I didn't think it was possible to do that. Even better than last year. So I'll get straight into it. Actually on that theme, look, the main thing is the main thing. So I would very much distinguish between ESG and transition. And transition has come up a number of times in a series of the panels earlier. It's about carbon, it's about knowing your carbon exposure and getting that exposure down, and it's one of the main drivers both of value and risk. So let me back up that statement in a couple of ways and then hand back. The first thing, if you look at, just to give some numbers, and I'll use GFANZ as an example here, 2 years ago, 100 plus institutions, 60 trillion of assets. 2 years ago exactly, at Glasgow, 450 institutions, 130 trillion of combined balance sheet. Now over 600, what's basically 700 institutions, 150 trillion of balance sheet, and that's 150 trillion of balance sheet that's being managed, you know, in a market that has gone down over that period. And about a third of those assets are transition assets, so assets that either are green or are headed in that direction, and increasingly, you know, brown to green assets. That's the first point. Second thing, if you look at public markets, and a big theme today has been about public-private markets, I'll just put on the table, there is a huge arbitrage between public and private markets around carbon. And part of that arbitrage is because of information, and I want to salute the HKMA in leadership on disclosure and on transition plans, things we'll get into. The third thing I'll say is that if you're long equity, actually, if you're long equity and long debt, you are long carbon. And there's two ways to reduce that exposure if you think the world at least is going to head in the direction of sustainability. One is to have companies that have plans to get that carbon down and to know that. And the second is to have some exposure to carbon credits or carbon credits in some form, and maybe we'll get into that. And then the last thing is just around risk. In the last 3 years, the scale of stranded assets in this region, in the Asian region, has doubled to $4 trillion. Now, that's $4 trillion if the world gets to sub 2 degrees. But directionally, stranded asset risk doubling measured in the trillions, so you need to manage this risk. Flip side, of course, is to grab the opportunity.
Impressive. I guess you all took notes. No, thanks, Mark. I think maybe Valerie, from from a fund manager's perspective, I think Amundi has been a leading global player, has been also leading in the ESG thematic, providing a lot of ESG-related product. So what do you think investors, clients look for ESG these days? And what is what is the investment industry doing to maintain the investor interest in sustainable investing?
Well, thank you very much, and thank you, Eddie, for your invitation. In order to answer your question, one word of introduction about Amundi. For those of you who don't know us, Amundi is the leading European asset manager. We manage around 2 trillion. And we've been managing assets responsibly for more than 15 years now. This is in our DNA. We've been working on the environment, social and governance data and analysis for a number of years. We have today around 830 billion of assets that we manage, including ESG criteria for our clients. So to answer your questions, what are our clients asking? Well, actually, it depends a lot on our clients. We're not managing assets for our own accounts. We're managing assets for our clients. So we obviously listen to what they want. But what I can tell you, and it depends a lot whether they are institutional, very large clients, or simply retail savers. So we obviously have a number of solutions for these very different clients. Let me start with institutional large clients around the world. We've seen a significant move over the past few years. Let's say 5 to 10 years ago, what we were mostly doing were including or excluding a number of stocks or states from their portfolio because they wanted not to get involved in a number of companies. Then we worked a lot about ESG criteria, worked on the companies, and then included in the portfolio companies or states which were really overperforming either in taking into account their environment or social aspects, with a strong belief that in the long run, investing or over-investing in these companies is providing value to the portfolio. What is right today, and I'm going to join Mark on that, is that the really important point is now to work on transition. So we have developed low carbon portfolio, but we are mostly today working with big institutional clients on transforming their portfolio in a portfolio which would follow the net zero path, which is a hard work. We already have around 30 billion of assets in that direction, and we'll have close to 400 billion by 2025 to comply with on net zero commitment. A very quick word on retail clients, because this is extremely different, actually more complicated, surprisingly more complicated because regulation is sometimes very complicated and it depends on the country where we are, and also because it has to be meaningful for them. So we're not so much in ESG, but more in impact or thematic funds to make sure they understand what they are investing in. And because we want it to be efficient, we also have developed net zero strategies for them, explaining them that this is the way to help company investing in their own transformation to get to 2050 at the right level. And maybe one last word about what you were asking me about what the investment industry could do. I think as a very large asset manager, our role is to educate, to help, to transform, to analyze, but also very much to engage with company, because we are very important shareholders of a lot of companies in the world. We are engaging them on their climate transformation, discussing, exchanging, challenging sometimes, and trying to make the whole community getting in the right direction.
Thank you, Valerie, for this investor, I would say investment perspective. Maybe so I turn maybe to Bill. I mean, from as a banker, Usually we are criticized for not going fast enough, sometimes too fast. So I would say that I think Mark mentioned it, transition finance is now becoming more and more important, and it takes time and effort to reach the net zero, particularly in emerging markets. So the business of transition finance is fraught with challenges such as lack of clarity in taxonomies, regulation. We understand that Standard Chartered launched the transition finance imperative 2 years ago. So could you share with us how can we scale up transition finance while maintaining market integrity?
Thanks very much for that question. Thanks for having me here, Eddie, and everyone. It's a huge question, and transition finance is obviously part of a much broader process of transition. The finance is the money part. But before we get to the money part, there's the question of transitioning from what to what, and we spend a lot of time understanding and thinking about what the starting point is, how we're going to measure that, and then a lot more time talking about what's a reasonable pathway from where we're starting to net zero. And there's not a very good answer to that as yet. So we know there are organizations like SBTI or the International Energy Agency that have come up with some, I'll say some relatively crude early stage assessments of what a good or appropriate transition looks like. But we haven't completely bottomed that out. And for those corporations who know they have to change their business model, and they know that they're going to have to raise financing to accomplish that change in business model, they're just getting on with it, and it's happening at pace. And I certainly from our client base, there's a tremendous willingness to undertake this transformation and make these changes. For those who are a little bit less inclined to engage in the transformation, there's 1,000 places to hide. And these places to hide are the lack of detail, the inconsistency, also some of the ambient noise. And I'm going to say a lot of the fringe community, the environmental activists who talk about transition but don't actually believe in a transition. They believe in a hard stop. But they make a lot of noise. Very, very damaging to the broader ecosystem, which is evolving quite fast. And for us to really focus on transition finance, we've got to be clear about what the transition is first. Finding the money it's not that hard. As Valerie just said, there's a ton of money. As Mark said, the supporters of and participants in GFANZ, trillions and trillions of dollars. What's lacking is standards. And what's lacking is a clarity around what's a good transition and what's good transition finance. We all have our apocryphal stories of having bought a carbon credit, paid real money out of our shareholders or other stakeholders, only to be told that we're greenwashing. Okay, all I know is I had $100, now I've got $90. I'm $10 worse off. I think I invested in a good project. You're telling me I'm a bad person because I did that. Well, that's a pretty big disincentive to do the right thing. How do we get into this quagmire? Because we don't have a consistent set of standards. The consistent definition of what's a good project, what's a good carbon credit, is a key component. And thankfully, there are initiatives there underway as well, including the Integrity Council for the Voluntary Carbon Markets, which Mark initiated a few years back, and like 450 companies have spent a lot of time getting a consistent set of standards. We've got to nail that, and we've got to get that, and then we have to buy into it, and governments and regulators and other stakeholders around the world need to support that. And then we need to make sure that as we're deploying the financing, that it's done in a just way. So as a bank that operates in very, very developed places like Hong Kong and less developed places like Sub-Saharan Africa, there's very different underlying taxonomies, very different underlying considerations, very different trade-off between the sustainability agenda and economic growth as a practical matter. If we don't have a just transition, i.e. we're not paying attention to the fact that citizens in different markets have the right to grow and prosper at the same time as they have an obligation to contribute to decarbonization. If we don't recognize that fundamentally, we're going to lose billions of people in the world as followers. And I can tell you, if you don't have those billions of people, you don't have a transition. So we've got to be pragmatic about this. We can talk some more about where the money comes from specifically, but we've got, the money sitting to my right with Mark wearing both a private equity and a UN climate change hat, and Valerie obviously running one of the biggest asset managers in the world. Money isn't the problem. Getting it into the right place credibly and consistently is a challenge.
Thank you, Bill. Well, you're very convincing, and I'm absolutely convinced. But Mark, I mean, you are expert in transition finance. Would you agree that we can both scale up and maintain market integrity?
I think we can, and look, I'll make this brief, and I would just go to our hosts, because Hong Kong has led the main elements of this. First, you've got to, you can't manage something if you don't count it, so you've got to have climate disclosure. It was the TCFD. Now, if you're outside of the US, it's the ISSB. Hong Kong's one of the first movers alongside the UK, Australia, Switzerland, others, 130 countries, 130,000 companies. By the end of next year, will be subject to ISSB mandatory regulation. That's the path we're on. So just to give you a sense of how quickly you can get ahead of that, you might as well get ahead of this room is ahead of most things, so you might as well get ahead of that. That's the first thing. Second thing, I learned one thing in the financial crisis, only one thing: plan beats no plan. That was the lesson from Tim Geithner. You got to have a transition plan if you're going to manage the issue. And again, Hong Kong is led with the consultation. I think it goes through the exchange, the consultation, right, Laura? But that's the standard, and what will be defined, I think, for COP28, and I'll finish on this, is that we will have a common approach, voluntary approach from the private sector through GFANs on granular transition plans, including, last point, something which is a complement, which is what's your expected emission reduction of your financing? So what impact do you think it has? Obviously, you look at the financial impact, but what carbon are you taking out net on that? And that all fits together. But the message I would leave for this room, if you look to Hong Kong, you see where the world's going. And if you don't believe that, call up the FSB, which has launched the initiative on this, which covers the rest of the jurisdiction.
Thank you, Mark. So maybe let me ask a question for Valerie and Bill, and I'll let you conclude later on, Mark. But where are the concerning development in terms of the public perception towards ESG? And we'll see new development, with technology embedding ESG, the green, the tech. I think this summer, Hong Kong has been the first one, I think, to issue a bond, tokenize the bond. So generally speaking, how do you see the potential for technology to speed up, providing impetus for the future development of sustainable finance? First, maybe Valerie, and then Bill.
Well, the way I see technology in this area is really as a tool to help. Let me be very, very concrete. If we want to manage portfolio cleverly for clients, making sure we fill with our fiduciary duties, and obviously the main duties, which is to provide good performances, but at the same time impacting in terms of transition, we need to make sure that we make the good decisions. Making the good decisions means having the good information. And it's actually one of the most complicated jobs we have on a concrete basis. We have billions of data. Some of them are interesting, some of them are not. Some of them are clean, some of them are not. Nothing will never replace discussing with the CEO about what he's really doing within his company to transform his business model. But on a concrete basis, in a company like Amundi, where we have 700 professionals and that we manage thousands of portfolios and billions of assets, we need to make sure that we are making the good decision everywhere in the world. So dealing with data, sharing this data, cleaning them, providing right information is absolutely essential. We have a very strong technology within Amundi, which is called the Alto, that we provide to our clients, and we developed over the last 3 years Alto Sustainability for our own needs, actually, because we really were needing this to be able to share with all our portfolio managers, analysts, the right information at the right moment. So we now have that. It's very performing. It's very helpful. We provide it to our clients when they want to have it internally as well. And I think technology is very useful for that. Now, speaking about AI, because sometimes it's a question behind the question, We are testing it very seriously because, once again, it helps you to get additional information and up-to-date information on companies. I would remain cautious, nevertheless, because at the end of the day, we need, once again, to be certain that what we're using to make choices are the right ones. So I don't want any black box within Amundi. I want to make sure that we remain extremely pragmatic on this information. So that's, for the time being, what we're doing, mostly Alto Sustainability, which is a great tool to help us to manage the portfolio of our clients efficiently.
Thank you, Valerie. Bill, maybe same questions?
I think the technology question can be looked at a few different ways, but just in sum, I completely agree with the points on data, also on taxonomy. One of the interesting technologies I think that is coming to bear, and in particular in the carbon markets, is DLT or blockchain technology, which is addressing one of the primary concerns in the market, which is around verification and who's done what to verify a particular project. Is it actually doing what it said? And I think an avoided deforestation project, is there actually logging going on? And how are we tracking that? Obviously, the ability to surveil with drones or satellite technology today is fundamentally different than when a lot of carbon credits were issued 20 or 30 years ago. So that form of technology around both verification but also tracking, assimilating data, and then mapping that against the various taxonomies is key. The other generic technology approach is the extremely exciting, I'll call it medium to long-term technologies being developed to extract carbon from the environment, either fundamental business model changes or things like direct air capture, which are very exciting, and they could provide a long-term solution. I worry a little bit that the excitement about some of these future technologies diverts attention away from the migration of business models today, and finding a way to keep the pressure on all of us in the short term. Because frankly, if we continue to burn the Kalimantan and the Amazon forests, there's not a lot that we can do in terms of direct air capture that's going to save this 2% scenario that Mark referred to. So we've got to keep the focus on the short term and be investing in these long-term technologies. Through that combination, obviously, if we bring the money to bear, I think we have a fighting chance here.
Thank you, Bill. So maybe I got my one of the last question, maybe to Mark. Of course, you know, I have to play for the French. I think the COP21 2015 was really a great breakthrough. It just happened to be in Paris. But I think, you know, you're gonna heading probably in Dubai, I mean, this month for the COP28. What is that you can share with us, Mark? I mean, what is the expectation? And for the financial industry, what do you think is going to be, you know, if you can share a little bit?
Sure. Well, actually, let me say the first thing is that, yeah, you're being modest, uncharacteristically modest for a French bank, but which is, it wasn't just because it was in Paris. I mean, absolutely, the French presidency drove that result. But at Paris, the world was headed to 3.5 degrees. Okay. Right now, the expectation, 7 years on, or 8 years on, is that we're headed to 2.4 on existing policies, but actually what countries say they're going to do by 2030 and beyond, we're headed to 1.7. So there's been a big shift in that regard. It has consequences for stranded assets. It has better, it's not everything, but we need to get there. Okay. That's first context. And there will be a formal stock take, but the numbers that will come out at COP will basically be that. What should we look for as the financial sector? First thing, and this is in public domain, you should look for a deal in the oil and gas sector. The question is how big and how binding. And the core deal that they're looking for is who's signing up for near zero methane by 2030 as a company, as a country, and doubling the energy efficiency of the production and distribution of energy. To give context, 10% of global emissions right now are from the production and distribution of oil and gas, not the burning of oil and gas, production and distribution of oil, gas, and coal. And you know, the hosts are being very aggressive and ambitious in trying to get as many countries and companies to sign up for that. So look to that, and it goes to a point which this room will appreciate. I mean, the time value of carbon is huge. So saving emissions today buys time for technological developments and progress, and just rolling out the scale of capital investment that needs to happen with proven technologies to get it. So first is on the oil and gas. Second, I'll make 2 points specifically on finance. Look for progress on the plumbing of finance. We talked a bit about transition plans and the mainstreaming and kind of the world catching up towards where Hong Kong and a few others are around that. And then secondly, and this is an aspiration, but I think we should be putting pressure on the COP presidency and the G20 to make progress on carbon markets. This has been a movable feast of developing standards and talking and talking and talking. Well, literally, the world's burning. And to put context on that, 10% of emissions today come from deforestation. Literally cutting down forests the size of the Netherlands every year in, year out. So having support for that and carbon credits can play a role in that and many other things, including the transition here. So that's the second thing, elements of plumbing around that. I don't think it all gets solved at COP, but it should launch the process to solve it, certainly by the end of the Brazilian presidency the following year. The third thing is look for something major on blended finance for emerging economies at scale, innovative structures that this room, if you want, you can be implicated in this. I mean that in a positive sense. And then the last point is, in the end, finance is the catalyst. It needs the underlying components. That's policies of governments and actions of companies. And there are a series of initiatives around industrial decarbonization that, and I don't want to front run the presidency, but there is a strong desire to take those to an entirely different level of decarbonization, and they're working hard around that, and I'll leave it to them to announce.
Yeah, Valerie, please.
Yeah, maybe just to add a positive touch to what you said, Mark, and I absolutely agree. Things have really changed. I mean, the fact that we see some backlashes today is for me a good sign, actually. It means that it is becoming real. So when it's real, it's a bit hard, but it's real. This transition is above all an industrial revolution. We need the states to frame it, and especially in the region, we see huge states around us that are taking strong decisions. We see corporates moving seriously and thinking about how they can model their new business organization. We, as the financial industry, can accompany them. We cannot do that for them, but we can accompany them. And as we were saying, there is plenty of money to do it, actually. So we still have 27 years. It's urgent, I agree with you, Mark, but I am absolutely trustful that both the intelligence of the human being and the fact that we have started this revolution will help us achieve the goal.
Thank you, Valerie. I think, I was asked to keep the time, so I won't have the time to ask a few additional questions that we have here. But it was very encouraging, very insightful. I think when we think about it, 10 years ago, we started all these ESG, greenification, transition, sustainability. At that time, it was still viewed as a niche. I think thanks to the asset managers, the banks, the bankers, and also the regulators, and the entire stakeholders, I think now it looks like all these niche has become close to mainstream. In a few years, it will be mainstream. I think Mark was talking about the stranded assets, and I think it's a great journey we've been in. I think we are all in to make this greenification and this planet better. So on that, I conclude, and I thank all our panelists. It was very, very insightful. Thank you very much, and please give us a round of applause. Thank you. Thank you.